Hi everyone, Ryan Oak with Oak Mortgage, powered by Dominion Lending Centers, produces West Financial. In today's video, I'd like to kind of go over the pros and cons of fixed interest rates versus variable interest rates. With almost all lenders, fixed interest rate terms can be 1, 2, 3, 4, 5, sometimes 7, as well as 10-year-long terms. And those are usually dictated by what's happening in the Canadian economy, especially around bond yields. So if you start seeing bond yields rising in price and or decreasing, you can expect that fixed interest rates with banks for mortgages are going to follow suit. It's not set in stone, but it is a general indication that interest rates are going to move. The length of term is also important. Most people are doing 5-year fixed terms over a 25-year amortization. What that means is you have your interest rate locked in, guaranteed for 5 years, but you're going to be paying off your mortgage for 25 years. After the 5-year term is up, your interest rate is renegotiable, and you'll have to take whatever that bank is offering at the time of renewal, or speak with a mortgage broker to switch lenders, or potentially go with another one and do a refinance. The variable terms, they're only offered on a 5-year term, and those are expressed as prime minus a certain discount. So if you had a prime minus 1, your interest rate would be whatever the prime rate is, currently 2.45%, minus 1%. What that means is your discount will never change throughout the 5 years. It will always be a 1% discount off of prime, but the prime lending rate can change throughout your 5-year term. Like the bond yields for the fixed rates, the prime rates with banks are usually dictated by the Bank of Canada's overnight target rate. That interest rate is reviewed by the Bank of Canada 8 times a year. So theoretically speaking, if they wanted to change that target overnight rate every single time they finished a meeting, you could potentially have fluctuations in your prime lending rate 8 times in a year. That is how those interest rates are sort of dictated. So if your interest rate is prime minus 1%, it's at 2.45, but in year 3, the prime rate is now 4.45, your net interest rate is going to be 3.45%. The pros and cons between them, the main aspect is, well, obviously volatility. If you have a variable rate, you might have one interest rate one month and a new one the next. Fixed rate, you know exactly what you're going to be paying for the whole term. What gets interesting is penalties. So if you were to get out of a variable interest rate term, your penalty will always be what 3 months interest is for your payments. So if your monthly mortgage payments are $1,500 and $1,000 of that $1,500 is interest, your penalty is going to be $3,000. If you were to break a fixed term and pay the penalty on that, you're either going to pay the 3 months interest or what's called an interest rate differential. The interest rate differential is a massive formula. It takes into consideration discounted rates, outstanding balance, remaining term. It's calculated out, and essentially it's going to let you know, or the lender know, whether or not if you pay out that mortgage, they're going to lose money, or if you pay out that mortgage, they're going to make money. How would a lender make money if you paid out your mortgage? Well, if you got an interest rate of 3% and they're offering new clients an interest rate of 4%, they will gladly take your money back and reloan it out at 4%, so they're going to charge you a smaller penalty. That's usually the main difference when it comes to fixed versus variable interest rates. A last little point there on them, why someone would need to break a mortgage is if they were in a 5-year term, 3 years into it, they decided, I need more space. They want to sell their home and move into a townhome. They might potentially have to pay out and break that mortgage. Some lenders do allow you to port your mortgage, which means taking it for one property and moving it to another property. If that happens, usually you can avoid the penalty. I have had clients in the past though where their interest rate was so high when they sold their home, they gladly took the penalty with the new term. If you are curious to know a little bit more about variable versus fixed interest rates, please feel free to reach out to us. You can connect with me through our website, oakmortgage.ca, or you can email us at info@oakmortgage.ca. Thanks for watching, and please subscribe to our channel so you can keep up to date with new videos.